and welcome. You're watching Financial Planner, and over the next 20 minutes, we'll be doing a very interesting conversation with none other than Feroze Azeez of Anand Rathi. Morning, Feroze. Thanks for joining in. Feroze, I want to start with a circular that SEBI had put out about 6 months ago for the mutual fund industry. I believe that's going to be put into practice as early as 1st of April, which is only about 2 weeks from now. Firstly, tell me about the circular, because we talked about a lot of this in detail a few months ago and then it sort of just disappeared in thin air. But given that the deadline is now approaching, what is this SEBI circular and how is it going to impact the mutual fund industry?
I think firstly, the SEBI circular very clearly exhibits that the regulator is applying mind to the way forward on the mutual fund industry. Point one. What does the circular end up saying is to simplify life for a mutual fund investor, because as a community we have only 1.54 crores people who are individual investors in the industry, and the larger portion of the people are outside. So for them to come inside, we'll have to create a very conducive, non-complicated environment. If you've spent 25 years of private sector mutual fund, in building that you would have created enough complexities which require some solution. So that's where it is aimed at. Point one. Of course, it says 3-4 very important things which changes an investor's life and an asset management company's way of managing money as well.
Right, but you know, like you said, this would make the industry or make the instrument far more attractive because it'll be less complicated. But while it becomes less complicated, it also becomes less competitive. So couldn't that be a double-edged sword, because if there's lesser competition, then performance, of course, may be impacted?
See,
or less to choose from, if I'm framing that correctly.
Correct. Of course, there will be clarity of your choice, not necessarily fewer schemes to choose from. Of course, it says there's categorization. Now, the first point it says is every asset management company can have only 10 categories of funds in the equity side. Now, what those 10 are, of course, today, one asset management company is running 3 large cap funds. Now, that's a very complex thing for a person to choose from. Even if he chose the asset management company, now he doesn't know which out of these 3 schemes in the large cap category does he need to choose. And there's a huge difference in performance. So what drives that? So you're trying to categorize schemes. So coming back to your point, will it create fewer options for an investor?
Maybe better options.
Better options, more pointed. You know what you're getting into. You exactly know what to expect out of it.
Just take a step back, right? I know that this is going to now, of course, be changed in the next couple of weeks. But to begin with, why would these asset management companies anyway have so many sort of funds to choose from?
See, what happens is, of course, when you're trying to grow your assets, an asset management company's aspiration is to grow its assets. So it will have to create new marketing ideas, new creative positionings for each product without actually identifying a clear gap. And that's what has happened over 20 years. 2 decades is long enough period to actually create different marketing stories and creating gaps which don't exist.
So what is happening currently underway? I believe the likes of a DSP BlackRock, Motilal Oswal, and a couple of other asset management companies have already gone ahead and changed their names. Others, of course, are waiting for regulatory approvals. Is that the sense you're getting as well?
Yes, of course. All of them have actually filed with SEBI their new list of funds. So this has a huge impact to the investor. He or she needs to see whether any of his schemes are being merged to come into fewer schemes. So point one, of course, all asset management companies have filed their new listings with SEBI, and some of them have got their approvals. They're changing their names, merging their schemes. Fortunately, asset management companies have kept it a little well planned that there are not too many schemes which are getting actually merged.
Right, so let's start by what this means for an investor in the long term. I know initially there's going to be some confusion because a lot of people associate a fund with a given brand. So it gets tricky to go out and then decide which is your fund and what is the name change to. But just before we do that, in the long term, this is a huge positive for a retail investor, and especially in a country like ours, where most part of this world, or most part of our world, which is India, does not even invest or even know about mutual funds.
Great. Of course, it's a very, very good move. So what does it first say? It says about 4 things which are very important. Point one, it says there are going to be categorizations, clear categorizations, and clear objectives defined. Point one. Okay, so there are 10 types of equity schemes which you can have: large cap, mid cap, small cap, large and mid, and there is a 10 categorizations, which is the first point. So if you're buying a large cap scheme, in the past, a large cap scheme could have had a reasonably large exposure in mid cap stocks, which is not what the client actually bought or the investor actually bought. So first point, that's what it says. Second point, it says the definition of stocks in the large cap category and the mid cap and the small cap category was very ambiguous, and to each its own was the kind of mantra before. Now it says the top 100 companies in the country are going to be categorized as large cap.
So they've changed that definition. Too.
Earlier, even a company with more than 10,000 crores would be called as a large cap. With this new definition, a company less than 10,000 crores of market cap is categorized as small cap.
So the definition has to be universal, which makes it a whole lot easier, right?
Correct.
I believe the regulator also had problems with words like advantage, credit, plus, opportunities, prudence, focus. So words that could potentially mislead the investor, right?
Absolutely. That's the third point I was getting to, and I think it's a very valid point. What used to happen now, if I take an illustration, the fund name actually becomes the genesis of a person's expectation, right? So if you look at some schemes called credit opportunity schemes, those are debt schemes which invest in low-rated papers, which are not AAA. But if you call it opportunities as against risk, then a person's perception is very different. So it's actually credit risk fund, not a credit opportunities fund. So name changes will bring in more clarity of what's to expect, and no marketing should be a part of the name of the scheme.
But Feroze, I mean, investors have a quick connect with popular schemes such as HDFC Equity, Reliance Growth, Reliance Equity Opportunity, ICICI Prudential Value Discovery, and the list is fairly extensive. Now, these are not just schemes, but these have become brands themselves. So while you might be going out and doing this because of regulatory hurdles or mis-selling or, protect the investor, at the end of the day, this is going to be a Herculean task, and it's going to be more confusing than adding value, I'd imagine, at least in the initial run of it.
See, I think you're right. Because the industry is very skewed towards fewer schemes, some of those schemes have actually become brands in itself. It will be more confusing to existing investors. Definitely, because you own them and you don't know what's changed to what. But for new investors, it will be so much more clear if you're speaking of HDFC Prudence. Now, Prudence as a nomenclature cannot be used. So now, for a person who owns it, now he needs to figure out what is it now called. But for a person who's coming in, it's more clarity. Of course, you're right. For the existing 1.5 crore investors, it will be a nightmare to figure out what schemes are going to be called.
So now that we've got 15 days to go, and I believe, like you agreed as well, that a number of funds are currently stuck on the regulatory side to get approvals that they're awaiting. How likely do you think that the deadline could be pushed? Because I think there are some parts of the media that believe the deadline could be pushed from 1st April to June, actually. I mean, it sounds a bit like linking your Aadhaar to every possible bank account and mobile account, right?
Correct. Since this is not a discrete one-time process, anyways, asset management companies are given time to follow the entire regulation in a quarter's period. So it is not like just a deadline. It's a circular which will require 3 months, and that's the time frame it is given for all asset management companies to comply with.
Do you anticipate a number of funds actually wrapping up some of their funds? Some of the AMCs wrapping up funds that they probably don't fit that definition of SEBI, and of course, might not have too large an AUM to handle either.
Yeah, unlike what I expected, the list is smaller. So I analyzed all asset management companies. There are 11 schemes which are getting merged with the rest of them. And if they're getting merged, those will not exist anymore. So currently there are 11 schemes identified which don't have a fate in the future.
So 11 will be dropped out. Any names that you have on this one, so we can tell our viewers what they need to sort of go back and look at in their portfolio?
See, I think this is a little nascent to name them, because it's fluid for a person to change till April 1st.
Okay, so we'll wait on that and we'll come back and discuss that. We'll take a break, we'll come back, but we'll also tell you what you need to be doing as an investor as you've got to sort of rejig your portfolio, make those changes, and of course change your mindset as well. So stay tuned. Welcome back. You're watching Financial Planner, and today we're talking about the SEBI circular that is expected to become a reality for mutual fund industry as early as 1st of April, and what that means, not just for the industry as well, but for you as an investor. Feroze, we talked about how categorization, definition change of large caps, and a name change is expected to change the way the industry operates and hence impact retail investors. But there are two other factors that you talked about that we still need to tell our viewers about actually that are also expected to change. So if you can just take us to those first.
Great. So firstly, I think there was huge complexity. Every fund used to compare itself to a chosen benchmark. The choice was made by the fund manager. Now there will be one benchmark, new benchmark created, which all mid-cap funds have to benchmark themselves to. Large cap funds, all of them have to benchmark themselves to a specific new created benchmark. So then you will have apple to apple comparison. Otherwise you are comparing apples and oranges. So this will bring in parity in terms of making a choice, because there are 128 mid-cap schemes. If all of them are comparing themselves with different benchmarks, you never know which one to pick. Now all of these will actually choose one benchmark which will now be created. That's a very big move for a person to make a choice, because if you have 450 schemes, out of which you have to choose 5 schemes, if all of them are using 10 different benchmarks, it's going to be that much tougher. Now,
how was the process getting done then? Because I mean, this sounds so convoluted, right? The way of comparing is actually different for a different fund.
Yeah,
so they could be all in the mid-cap category, but they'd be compared to different benchmarks.
Correct. You have a CNX mid-cap, somebody's comparing himself to, somebody's comparing BSE 500. So there was no one snapshot for a person to make a choice.
So have they determined what that snapshot is going to be? Is it going to be CNX mid-cap? Is it going to be BSE 500?
New benchmarks which are called mid-cap 150 and large-cap 100.
Which doesn't exist already, so that's a new creation that they've come out with.
Absolutely.
So of course, now you'll have, so assuming just to sort of put this in words, so if you have an IT fund, it won't be compared to the CNX IT fund. There's going to be a new benchmark that there'll be comparisons for.
See, these peripheral categories are not that important. Large cap and mid cap, which is the core of one's portfolio, 80-90%, those will have specific.
And of course, with the definition of large cap changing anyway, you'd expect that new sort of benchmark to be introduced. Apart from that, anything else that we need to tell our viewers? I believe there's been some change in recognizing dividend, because I think mutual fund industry is being very smart about how they were, showing or selling to their potential customers.
Absolutely, that's called. And so what used to happen was, that's the 5th point, and I think it's an important point. Whenever you have an index don't have dividends included, but actually if you're holding those stocks in the index, you get a credit of the dividend. The fund manager used to compare himself or herself to the benchmark, which actually doesn't have dividend. So naturally there was a 1.5-2% advantage to the fund manager when he was doing a relative comparison and showing yourself actually better than you are because you got a dividend credit. Of course there's an expense, but the expense was largely mitigated by the dividends. So going forward, there's going to be the indices which are created are called total return index. That will actually add back the dividend to make a comparison whether you're doing better than the benchmark or not better than the benchmark. So this advantage of 2%, 1.5%, the fund manager used to get when comparing himself or herself with the benchmark would go away. So it's going to be very difficult for the fund manager to beat the index now if you add back the dividends to it. That's the 5th point.
Well, that's a very valid point, right? Because at the end of the day, it was a free lunch or a free ride that these mutual funds were riding on, with this hidden sort of 2%, 1-2% gain that dividends was making up for. Well, also, Feroze, in that case, then how does this make life easier? Apart from lesser confusion, large fund houses, of course, we know will be impacted a lot more than the smaller ones. How does this change life for you and me as investors?
Absolutely. It changes. One is that if schemes get merged, they become larger. If they become larger, it becomes tougher for the fund manager to perform. The smaller schemes have a tendency to do better. There's an analysis which says smaller schemes have a better propensity to do very well. So there's an optimal size of the fund, but if you're merging schemes, then automatically you will have larger schemes. That's point one. So you have to be very, very careful in making choices which are not very, very large schemes. Point two is that you will have to hold schemes for next 4, 5, 6 years. So you will have to make sure that that the LTCG impact combined with the SEBI regulation becomes a completely different paradigm shift in terms of how you're making choices, because you have to stick to your choices for 5, 7, 8 years. So the way you choose can't be the rear view mirror, seeing past performance and choosing. That's point 2. Point 3 is that when you actually are choosing schemes, you will get performance will get impacted, because now large cap schemes earlier used to have small stocks and create performance. Now they will be restricted largely. So mid cap schemes only have 30% in the new definition of the mid cap. So 70% was coming from other universe. So that extra performance which the fund manager was able to generate by straying from the objective will now be restricted. So in the new regime, performance is going to be far and few between. You will have to stick to the very, very good funds and their fund managers. If you went a little aside, your performance can get dramatically impacted, because there is huge restriction. Huge restriction in movement could mean a lower performance.
You know, one space, I think we largely talked about equity mutual funds. I just want to ask you about debt mutual funds, because I think they seem to get sort of more shaken up, because there was gazillion definitions of these debt mutual funds, right? SEBI has now said it's either going to be on accrual or on duration. What is this going to do? Because at the end of the day, a lot of these debt mutual funds would change their investment strategy pretty much annually, right?
Correct. So debt, fortunately, on the debt complexity side, more corporates have created larger complexity, because there are different schemes run differently for just the expense ratio. So that's the kind of complexity on that side. From a retail investor perspective, either it's accrual or duration. What do you mean by accrual? It's important for anybody who owns even one debt scheme to understand what is accrual. Accrual is when a fund manager buys a bond, holds it till maturity largely, and benefits from the interest accrued, as the name suggests, by the bonds he is holding on your behalf. Duration is trying to make money on movements of interest rate. Not just the interest which comes to you, movement of interest rates also impact the performance of a duration scheme. So like, for example, in the last 3 months, interest rates have gone up. Duration funds would have actually made losses for investors. That's a duration fund. If you're on the high risk category on the debt side, which itself is counterintuitive, then you will buy a duration fund. If you want to enjoy the high interest rate which Indian economy actually has to offer, then you will take
And those are the only two definitions that SEBI is going with for now. So they're not going to make it complicated. They're going to ease it out for retail investors. Also, I know, of course, the financial planner will be assisting investors of how they should go about, rejigging their portfolio or identifying the funds that they were initially invested in. But for those who don't have a financial advisor, it's usually rating agencies. They usually go to a rating agency, maybe a Morningstar or a Value Research, and they look at what these ratings are. Are rating agencies equipped with dealing with this change? Because I think that's going to be important for first-time investors.
Absolutely. Quite a few people who are retail investors can't afford an advisor today. And that's the larger audience we are trying to address with the circular. So if that's the case, of course, rating agencies, which become the primary driver of advice.
I think the job also gets easier, right?
Yeah, it gets easier. Of course, there are rating agencies who are completely on this job. I personally think first month or couple of months it will take for the dust to settle, but I think the engine will work as efficiently as it is.
So and neither is this a hard deadline, right?
It's for some portion of the circular it's a hard deadline, some portion it is a transitionary phase.
So for what portion is it going to be a hard deadline? Name changes. But what about AMCs that are stuck on the regulatory side for that name change approval?
No, I think that will come through, because that's just because if the approvals are sought on the basis of the guideline given, it'll not.
And what happens that interim while you've made investments in a couple of funds and then there's that name change and the execution part of it? I'm just trying to understand how this is going to impact actions. So what am I supposed to do if I hold an investment in, say, a DSP BlackRock fund and the name has changed, nothing happens, my life doesn't change. I just stay invested on that fund.
Correct. Name change doesn't impact you. What can impact you is the merger. If there's a merger, then you get, very important for viewers to know, is that they get a 1 month free exit period.
Okay.
Okay, if you are having a scheme which is going through a transition in the objective,
you get that 1 month.
1 month free period. That is not just for the schemes which are getting merged, it is for a lot other schemes which are changing their definition.
Okay, and what about schemes that are getting wrapped up?
So those will never get wrapped up. Assets would move, and merger is what will happen.
Okay.
Right?
Okay.
You would not have a scheme.
So they just move the AUM from a wrapped up or a merged to the group.
Correct.
Scheme,
and if
I
you
guess.
have a scheme going through that transition, it's again very important to know, because you're merging two schemes, the scheme might have, one scheme might have 45 stocks, the other might have 40 stocks. If there are no unique stocks, suddenly you will have 70 stocks in your portfolio. And that could be an underperformer in the next 1 year. So if you're going through this transition of merger, very important for you to be seeing whether that's the strategy you want to follow. Point two, even if there's no merger, you might get a free exit period. Use it if you don't like the newly defined objective.
I think apart from this being a positive in many ways, the other positive is that people who are very, not lazy investors, but very sort of investors who don't look at their portfolio often, this might force them to actually go back and, see how well their investments are doing and sort of take stock of the situation.
It's a forced review.
Yeah, forced review. And I think that's a good thing. In some way or form, that's a good thing. We'll take a break on that note. We'll come back and we'll tell you another circular that came out yesterday where we believe that investing in mutual funds may actually get cheaper. So we'll talk about that in a bit after this break, so stay tuned. Welcome back. You're watching Financial Planner. So far, of course, we've talked about how SEBI is going to protect investors like you and me from mis-selling, and hence they've, of course, gone out and changed a number of definitions of the mutual fund industry. But Feroze, I believe this week you've also got some news where SEBI may soon ask mutual funds to actually cut back on expenses fee that they charge investors. I know that's going to be taken up at the next SEBI board meet, which is on the 28th, but is this going to get cheaper for us to invest in mutual funds now?
I think the way we are headed, of course, it's going to be very cheap for an investor like you and me to invest in mutual funds. So much so that the long-term capital gains impact, which is a 10%, can be almost halved by just this move. So before we understand what is the kind of reduction, it's important to understand there are 5 different kinds of heads under which an asset management company charges a mutual fund. That's a very complex game. One is the total expense ratio, okay, which ranges on the size of the scheme, point 1. Point 2 is that they charge over and above that an investor education budget, which is a very small component, 0.02%. Then the second large one is the asset management company can charge you 0.2% more for potential exits of different other investors. That is what SEBI is now looking at bringing down. So apart from the expense ratio, an asset management company can charge you 0.2%, which is a reasonably large corpus, for potential exits of short-term investors. So long-term investors end up paying on behalf of the short-term investor, which is not so fair. Third point is cities, which are the larger cities, used to compensate for remunerating the smaller towns. That was called the B15 expense. Now it is B30 expense. Briefly, basically, if I'm a Mumbai resident investor, I would be paying for somebody who's investing from a smaller town. That was 30 paisa. Over and above the expense ratio. And then you have service tax, which is now GST, also gets charged. So if you add up all this, it is not very clearly expressed